Welcome to my economics channel, where I love discussing the subject, but most importantly, I love to make something fun and interesting to learn. And to that end, I want to discuss the impacts and the implications of very recently the decision by the majority of the Australian banks to lower their variable interest rates on their home loans, whilst interest rates on their fixed mortgages remains either the same or actually has been increased. And so this would send out a signal that, at least to new customers or customers wanting to refinance, that they can do so with a variable rate and at a lower rate than previously. So they're trying to get people into the variable rate. But why is this? Why is it that all of a sudden the variable rate is lower than the fixed rate? Previously, the fixed rate was higher because you as a customer, you as a client, you took on a lot of risk. If interest rates were say 5% and you fixed for 3 years, which seems to be the most typical period of time that people in Australia fix their home loans for, that was then a risk that interest rates would go lower and you would miss out on being able to finance or refinance your house at this lower rate. And then whilst everyone else's mortgages repayments are going down, yours are staying the same as they were previously. However, it's very curious that the banks are doing this now and that they're doing it all at once. So what gives? So what I suspect is going on is something a little bit cheeky. See, originally the RBA had signaled and had strongly suggested that all the way up until 2024, rates would remain very, very low, or at the very least very close to where they are right now. Which is the official overnight rate, or the cash rate, as it's called here in Australia, is 0.11%. So this meant that if you bought a house recently, and regardless of whether or not you fixed the interest rate on your mortgage or you got a variable rate mortgage, you could be fairly sure that all the way up until 2024, and I think they're even saying up to all the way until the end of 2024, you could then rely on having very low mortgage repayments for the entire period. And then after that, interest rates are expected to increase. However, at least you've had this grace period up until that point. However, all of these banks are suddenly trying to get people into variable rate loans. The reason for this is that variable rate mortgages are tied or very closely connected to the overnight interest rate or the cash rate. And with recent developments in Australia's economy, that rate, the overnight rate, is expected to actually rise by mid of next year, not the end of 2024. So this means that banks actually want you to get a variable rate interest now, which is lower than the fixed rate, because they strongly suspect or they strongly expect that the interest rate will actually rise mid next year. This will mean as interest rates rise, they can pass on those higher interest rates to you, which means higher mortgage repayment. Whereas if you fix at the really low interest rate right now and the rates rise, they cannot pass those on to you. So naturally, this is not financial advice or anything like that, but I strongly suspect that is what is going on. But it's also the story of what's going on behind the scenes. So the reason that actually the 3-year mortgage rate is as low as it is because the RBA, the Reserve Bank of Australia, has been running a bond buying program, and more specifically buying the 3-year Australian government bonds. Because the RBA had lowered the overnight interest rate down to 0.11%, which helps people on variable interest rate home loans, it then wanted to help those who either have a fixed rate mortgage or want to get a fixed rate mortgage. And because those people who are going to fix their home loan typically do so for 3 years, they then started a bond buying program, which was buying up the 3-year Australian government bond. It should go without saying that people who fix their mortgages for 3 years, the interest rate that they're going to get is strongly related to the 3-year government bond rate. And so it's very similar to quantitative easing in that the RBA will be purchasing a large amount of these 3-year bonds, which pushes up the price and then lowers the yield. And it works because prices and the yield, or the interest rate, they run inversely. And conversely, if the interest rate was to increase on the 3-year government bond, for example, then the price would drop. And so by way of an analogy, what the RBA was doing was walking the yield curve. So you have a yield curve which typically looks like this. And that just means that starting from down here, which is what interest rates are today, we expect them to be lower today than they are in the future. And at the moment, they're 0.11%. However, in the future, that's something that the RBA doesn't control directly. It directly controls the overnight interest rate. So it starts this bond buying program to then push to depress yields lower on the 3-year interest rate. And so then through this bond buying program, the RBA can affect interest rates 3 years out, and so walking the yield curve, steepening, flattening the yield curve. The reason I bring all of this up, and the reason this is so interesting and such a fascinating topic, is that recently the RBA actually declined to defend this 3-year peg. It is actually winding down its 3-year bond buying program, which means that because of their actions, they were actually able to lower the 3-year interest rate. Absent these actions, the interest rate will increase. And this is what most people expect. And so this is why the banks have lowered their variable interest rate loans and not their fixed interest rates. And so with interest rates on 3-year Australian government bonds expected to increase, that means it's going to be more expensive for people who want to get a mortgage now and fix it for the next 3 years. Which is why, going back to what I was mentioning at the start, the banks all got together, or independently, whatever it is, they then lowered their interest rate on their variable rate home loans so that people get more of these rather than fixing a home loan at the quite low interest rate that it is right now. And this doesn't have to come from me. We can actually get this from the RBA's own website, which, as a side note, I have to say is surprisingly readable and very informative and entertaining. And so on this topic, the RBA says, quote, "When households, firms, or governments borrow from a bank or from the market by issuing a bond, their cost of borrowing will depend on the level and slope of the yield curve. For example, a household taking out a mortgage might decide to fix the interest rate on their home loan for 3 years. The bank would calculate the interest rate on this mortgage by taking the relevant term on the risk-free yield curve, in this case the 3-year term, and then add an amount to cover costs and to compensate for the risk that the borrower might not repay the loan, credit risk. Different terms of the yield curve are important for different sectors of the economy. For example, Australian households that borrow using fixed rate mortgages usually only lock in an interest rate for 2 to 3 years, so this part of the yield curve is important for fixed mortgage rates." We then get more from the RBA, quote, "In response to the pandemic, the Reserve Bank sought to assure borrowers and lenders it would help keep interest rates low for 3 years by directly targeting a 3-year bond rate equal to the prevailing ultra-low cash rate through market intervention," end quote. And so now going forward into the future, we have a situation where we are now getting higher inflation in Australia, but also higher expected growth. This means that interest rates in the future are expected to also be higher. The idea being that many interest rates in the economy, they move with the overnight interest rate or the cash rate. So as this increases other interest rates in the economy, and this will increase expenses on customers and businesses alike. The idea being that the economy no longer needs these ultra low interest rates, and we don't want runaway inflation like we saw in the 70s and the early 80s, so we actually need higher interest rates going into the future. And so with mortgage repayments, which for most people is their biggest monthly expense, with those increasing, you're typically going to decrease your other expenses, which of course includes spending in businesses. With aggregate activity in the economy going down, this is how we can slow down the economy going forward, and hopefully we can tame or we can rein in inflation, and we're not going to get problems in the economy associated with higher inflation or inflation that might not be quite as high but stays with us for a longer period of time. And so the idea being, of course, that even though your monthly expenses are increasing and you're not going to spend as much money into the economy, we would say that on aggregate, this is actually a good thing. It means that the economy is doing well, and we're not going to get all of the other risks and the other dangers associated with these ultra low interest rates. So I was mentioning previously how the RBA, and of course central banks in general, they control the overnight interest rate or the cash rate in Australia, and longer term rates tend to be market rates. And in this case, I was saying that the RBA was walking the yield curve with its extraordinary bond buying program, essentially quantitative easing. So extraordinary times call for extraordinary measures, and the RBA wants to be there to support the economy. However, it's not entirely true that the RBA can just choose an interest rate and then leave it at that. The RBA controls or has heavy influence on the interest rate because it works very closely with the member bank, with the big banks of Australia and the reserve system. And so all of the money, all of the credit that we have in the economy, all of that is influenced by the amount and how the reserves, which the Reserve Bank of Australia controls, and how that is used with the member banks. And so by doing fancy operations, which I won't go into this video, but by doing these operations with the member banks, the RBA controls reserves, it controls the level of reserves, or it might choose an interest rate and let the reserves do whatever they need to. But this being a closed system, it controls this system, and this is how we get our interest rates. It's all done through the financial or the banking sector. But of course, banks are influenced by the wider economy. So there's feedback going on with the Reserve Bank of Australia, the reserves, the banks, and then rest of us down below. And so we interact with the banks, which then influences how they use reserves with one another and the RBA. And then this can influence the interest rate. What I mean by this is that our activity out here, that determines what we call a market rate of interest. We can't directly observe this, although we can estimate using really fancy math and really fancy models. But our activity out here, our aggregate activity, that influences the banks. That does things with the bank's balance sheet, and then they interact with one another and they interact with the RBA. That helps determine, or that helps set, some market rate of interest. What the RBA has to do is actually understand what the market rate of interest is, and then set a cash rate, an overnight interest rate, either to the market rate or as close as possible. If these rates are out of whack, then we're going to get imbalances and we're going to get problems in the economy. That is to say that with the ultra low interest rates right now, that is not entirely up to the RBA. That is our aggregate activity. That's the economy. That's the Australian economy saying, right now we need ultra low interest rates. However, potentially from middle of next year, we're actually going to need higher interest rates. And so this is why, or this is one reason why, the RBA abandoned, or at the very least slowed down, its extraordinary bond buying program. And so with higher inflation and higher expected growth, this signals to the RBA that interest rates, that the market interest rate going from roughly middle of next year, or maybe towards the end of next year, will be higher. The RBA then has to listen. Otherwise, interest rates will be out of whack, and then we're going to get real problems in the economy. And this is why, or this is one of the main reasons why it's abandoned its program, and why banks in Australia have lowered their variable interest rate for their home loans, because it's trying to entice more people to get variable interest rates, given that the market is signaling, or the aggregate economy is signaling, that interest rates in the future are going to be higher. And just to quickly close off with, there's actually an argument that during 2008, even as the Federal Reserve was lowering interest rates all the way down to zero, there's actually an argument that the market rate was actually higher than the Federal Reserve's interest rates as it was dropping them. The argument goes that even as fast as the Federal Reserve dropped interest rates to near zero, it actually didn't do it fast enough, and money, despite interest rates being very low, was actually too tight. And that many businesses that needed to get money or credit couldn't get it. It was actually too expensive for them. And this was a drag on growth, and a drag ultimately on the recovery that happened after. And so as powerful as we might think the Federal Reserve is, it actually must listen to the market in exactly the same way that the RBA must listen to the market in Australia. But that's all I wanted to say for this video. Thank you for watching. If you have any questions, don't hesitate to ask below and I'll do my best to answer them. Or at the very least, I'll get the questions and answer them in a follow-up video. And it would be awesome if you subscribed and shared, as that helps my channel, helps me grow, and obviously gets me more views, and possibly in the future helps me earn money, which would also be awesome. Thank you for watching, and I'll see you guys in the next video.